As the second largest cryptocurrency by market cap, Ethereum attracts many traders and investors. Like Bitcoin, ETH is a decentralized digital asset that can be traded on cryptocurrency exchanges and stored in wallets with unique alphanumeric strings. However, they differ in their approach to leveraging blockchain technology. While Bitcoin remains focused on refining its role as digital gold, Ethereum aims to become a decentralized platform for smart contracts and dApps. What is Bitcoin? Bitcoin is a virtual currency that exists in the digital world and does not have any physical form. Instead, it is backed by the blockchain, a network of computers that manages and records the cryptocurrency's transactions. This decentralized system is part of what makes it so appealing to investors. It's free from the influence of governments and other third parties. This is what makes Bitcoin different from other currencies. Bitcoin was created in 2009 by a man named Satoshi Nakamoto. Nakamoto's motivation was to create a peer-to-peer electronic payment system. This would allow people to send money directly from one computer to another without the need for a trusted third party like a bank. It took Nakamoto a few years to complete the project. When it was finished, Bitcoin was released as open-source software in January 2009. A few months after the launch of Bitcoin, another cryptocurrency called Ethereum was developed. This new cryptocurrency was built on the same blockchain as Bitcoin and offered developers the chance to build a wide range of applications. Unlike Bitcoin, which can only be used for transferring value, Ethereum is a platform that allows for the creation of decentralized apps that have limitless potential. It's like a computer that can play games, write essays, and make slideshow presentations, but also has the power to run any application you'd like. Ethereum is a unique cryptocurrency because it has its own native token that's used to fund these decentralized apps. This token is called Ether and is the second most popular cryptocurrency in the market. People often talk about trading Ethereum, but they're really talking about Ether. In addition to its use as a currency, Ether can also be used to validate other transactions on the Ethereum blockchain. This process is called proof of stake and involves locking away a certain amount of Ether to participate. The more Ether you stake, the higher your chances of having your transactions verified. The main advantage of this process is that it uses less energy than the Bitcoin blockchain. However, it is not without its drawbacks, which include an increased risk of double spending and a delay in verifying transactions. What is Ethereum? Ethereum is both the second largest cryptocurrency and the blockchain network underpinning decentralized applications. Its native currency is the Ether token, and it's an open-source project. The founder of Ethereum, programmer Vitalik Buterin, first proposed the idea in 2013 as a way to expand the use of blockchain technology beyond Bitcoin's limited capabilities. Ethereum's key difference from Bitcoin is the smart contract functionality that powers its apps. Smart contracts are computer code that execute automatically based on real-world data. For example, if a freelancer's work is done by the deadline, the smart contract will release their compensation. This eliminates the need for a third party to oversee the transaction or enforce its terms. In addition to its smart contract capability, Ethereum is a platform for developers to build their own projects. These are called dApps and can be used for a variety of purposes. In the past, these dApps were primarily financial services, but they're now expanding into other areas like gaming and non-fungible tokens, NFTs. Ethereum has become the dominant platform for these types of projects. NFTs, which are digital tokens that represent a piece of real-world property, are another big reason Ethereum has exploded in popularity. The Ethereum network was the first to support them, and many other networks now use their own versions of this protocol. The Ethereum blockchain is designed to handle the growing volume of these transactions, so it can scale as demand grows. The Ether coin's value is affected by a number of factors, including investor sentiment and the popularity of apps built on the network. It also is subject to volatility, which makes it a risky investment for those who aren't prepared for a large price swing. As with any type of asset, it's important to familiarize yourself with the history and characteristics of cryptocurrencies before investing. This will help you anticipate possible risks and make better decisions about how to manage your portfolio. As with all cryptocurrencies, Ethereum's value is determined by supply and demand. Investors buy Ether coins in order to hold them, hoping that they will increase in value over time. They can store their Ether in a cryptocurrency wallet, which is a secure place for storing virtual assets. There are several different kinds of wallets, ranging from online apps to physical devices like specially designed USBs. What are the differences between the two? There are several differences between Bitcoin and Ethereum, although they both leverage blockchain technology. While Bitcoin operates as a store of value with a focus on decentralization, Ethereum goes far beyond that by providing a platform to facilitate complex smart contracts and dApps. This is what makes Ethereum more versatile than Bitcoin, as it can be used for everything from financial transactions to NFTs and more. NFTs are a form of digital collectible that can be traded or redeemed for goods and services. NFTs are used across a number of industries, including gaming, social media and financial markets, as they can be easily verified and transferred online. NFTs are also often backed by real-world assets, such as gold or silver, adding an extra layer of security for investors. Both Bitcoin and Ethereum offer support for NFTs, with ETH being the most popular cryptocurrency for the purpose. Another difference between the two is their respective transaction fees. While Bitcoin transactions typically have lower fees than those of ETH, this can change depending on the network's congestion and demand. In addition, ETH transactions require higher computational power to process than those of BTC, which is why its fees tend to be more expensive. As the second largest cryptocurrency, Ethereum offers a more diverse set of uses than Bitcoin. This is why it's a better choice for those looking to invest in a more innovative tech space. For instance, Ethereum is a better option for anyone looking to carry out transactions requiring smart contract functionality, such as funding a loan that automatically pays back on a certain date. The two cryptocurrencies also operate differently, with Bitcoin using a proof-of-work system that relies on miners to validate and add blocks to the blockchain, while Ethereum utilizes a proof-of-stake system. The former is more energy efficient but less secure, while the latter provides a more secure alternative that requires validators to earn the right to create new blocks by staking their ETH tokens. This also makes Ethereum more stable than Bitcoin, as its network is less susceptible to attacks and has a greater potential for future growth. Which is better for investing? When it comes to cryptocurrency investing, investors need to understand the differences between Bitcoin and Ethereum. Both are major players in the blockchain ecosystem, with each offering unique features and value propositions. In addition, each has its own underlying technology and use cases. Bitcoin is known as digital gold, acting as a store of value. Ethereum enables the development of smart contracts and decentralized applications, dApps. The two also differ in their consensus mechanisms, with Bitcoin using proof of work while Ethereum has begun transitioning to proof of stake. Both assets have a high market capitalization, with Bitcoin currently dominating the market by a wide margin. Moreover, they play pivotal roles in the crypto landscape and have attracted attention from investors, developers, and enterprises alike. Despite this, the two are fundamentally different in terms of their underlying technology and value propositions. While both are highly scalable, Ethereum takes the concept of blockchain technology one step further by enabling a decentralized application platform. The Ethereum network is powered by its native currency, Ether, which is used to pay transaction fees and execute smart contracts. Ethereum uses a proof-of-stake system to maintain the integrity of its blockchain and incentivize validators. This enables the network to process a large number of transactions at a much lower cost than Bitcoin. Unlike Bitcoin, which has a set limit for how many tokens can be mined, the Ethereum network has no fixed maximum supply. This allows the market to determine the price of ETH, which is influenced by demand and investor sentiment. In addition, ETH is the only cryptocurrency that can be earned through staking, which is the act of rewarding other users for verifying transactions. This provides an additional source of liquidity and is a popular investment strategy. Both Bitcoin and Ethereum offer compelling investment opportunities, especially in the long term. They are the backbone of a new digital economy, and investors can expect significant growth in the future. However, it is important to be aware of the risks and rewards associated with investing in cryptocurrencies, as volatility is common in the industry.